Manishi Raychaudhri is strategist and head of research at BNP Paribas Securities. He's joining us right now. Manishi, thanks very much for your time. Good to have you with us here. So I just want to start with takeoff from Friday and the big rally that we saw. What really was the reason in your assessment, Manishi?
Right. Well, honestly, I don't know, apart from what has appeared already in the print and electronic media. It was clearly an electoral hope-driven rally. There were rumors in the market that, some of the large investors and traders had their own kind of exit poll surveys conducted, but I have no idea whether that was the case or not, and all I know is what appeared in the electronic and print media. But one thing appears certain, that there is a lot of political hope that has got baked in to the valuations. In fact, now one hears of numbers which are close to about 240 seats, 230 to 240 seats for the BJP alone. And if that is indeed the case, then you would obviously have the NDA getting a majority on their own, which would ignite hopes about a pro-growth, right-of-center kind of stable formation, which is obviously important and which is enthusing for the investor base.
You said 230, 240 for the BJP alone. Can you just detail those numbers? I mean, which survey are you pointing about, or this is, just out there in the market?
Yeah, these are the kind of numbers that we were hearing from our interactions with the domestic institutional investors. And apparently, these were the numbers being talked about. But I don't think they have been published in any formal opinion poll survey. So, let's wait for the exit polls to come out this evening and tomorrow onwards. I think the investor base would get a better sense of what's likely to happen.
Manishi, at the beginning of this election season, I was told by not one but a few people in the market that large institutional investors are actually commissioning their own polls, opinion polls, etc. I guess that would include exit polls as well. Do you have confirmation of that? Do you know investors who are doing that kind of thing without naming them? Is that happening this time?
No, an honest answer is I don't know. I've heard the same, what you just talked about. But those are the things that we have heard in the electronic media, and they have been discussed in the print media as well over the weekend. But apart from what the media has discussed, I have no knowledge, or at least no first-hand knowledge of anything of that nature having happened.
Right. Okay. Fair enough. So after this, and banks were the biggest movers, right, Manishi? Does that tell you anything?
Well, if one bets on a strong pro-growth kind of government, then the obvious reaction would be to bet on the domestic cyclicals. And that is where you have banks, industrials, maybe even select consumer durables and consumer discretionaries. And it's not a surprise that those were the sectors that were well bid on Friday, and that trend seems to be continuing today as well. One must also not forget that these were some of the sectors that were beaten down the most, and over the last couple of months, therefore, these are the sectors that are recovering the most. Even within banks, you would have noticed that the public sector banks, which possibly have the maximum to gain if there is an economic upturn, those are the banks which have possibly rallied the most. Having said that, I think the fundamental concerns about the public sector banks are not yet over. So, for institutional investors, it would be prudent to remain cautious on that universe. And we're still recommending larger weight on the private sector banks.
Right. But it's the PSU names which are doing most of the running up right now, Manishi. You're saying, well, precisely for that reason, one should be a little cautious there, and private names are better.
Yeah, see, I would combine that with the fundamental concerns also. because I think the fundamental concerns about PSU banks, which pertain to the non-performing loan problems, the asset quality problems, and the kind of capital that they would have to raise to maintain their Tier 1 capital ratio, that still remains a problem, area of worry for these PSU banks. So if one has to play the PSU banks, I would recommend taking exposure to the relatively low-risk PSU banks, where the asset quality concerns are not so severe, and where the quantum of capital raising required to maintain the Tier 1 capital ratios are not so high as their peers. So, if you recall what we did in early March when we rejigged the India model portfolio significantly more towards the domestic cyclicals, we went overweight on financials and we added one PSU bank, just one, which was Bank of Baroda, which actually qualifies with all these criteria and all these conditions that I talked about just now.
Fair enough. Manishi, I'll get back to stocks, sectors, etc. in just a bit. I want to ask you, what is your sense after the rally that we have had? Do you think there is still, do you expect, and people that you expect, do people generally still expect to be surprised by the election result and surprised positively after what we've seen?
Well, I think over the last 2 or 3 days, a significant degree of positive surprise element which used to exist previously has already got discounted in the share prices. So I think, from here to be surprised significantly by the results, one would need a really strong and stable formation, with, possibly the NDA getting a majority on their own. If that happens, then you could see still some more upside in this market, maybe another 5 to 7%, possibly Sensex touching 24,000 or more. But, I think anything below that, is possibly already factored into the current valuation levels.
Right. No, so what's the, exit poll numbers will start to come in. What is your sense? Will markets react to the exit poll results? Or do you think the exit poll results will have to be very meaningful, either up or down? More than, say, 260 for the NDA, less than 220 for the NDA, on either side. Only then you will see a reaction.
Whether the market would react to the exit poll result would obviously depend on, what the exit poll results predict. So, suppose the exit poll results talk about 260 to 270 for the NDA or even higher, then I think you would get a fairly positive reaction from the market. At the same time, we have also seen historically that the exit poll results have not been an exact mirror of the results that come through. In fact, on a couple of occasions, we have seen pretty significant divergence. There were negative surprises. I think one should be slightly cautious about that also. But if one focuses solely on the exit poll results, then for a negative surprise to come through, it should be close to the number that you mentioned, somewhere around 220, 225, 230 for the NDA, which, I think is the market is expecting a lot more than that right now.
So the market is positioning, right, in cyclicals in a very strong way. Does that, is the positioning telling you that a reversal in earnings for that sector is coming, or is the positioning essentially going to get disappointed? Because, stocks have moved up. One way to look at it is that, that's basically the run-up before earnings turn. The other way to look at it is, nothing will change. Hopes will get dashed. Valuations are too high now. They don't match earnings, so they're a recipe for disaster. What's your sense?
I think selectively there could be an upturn or a reversal in the earnings trajectory as well, which is already beginning to happen. If you look at the last 2 quarters, there have been a small positive surprise in the Indian earnings environment. Sometime around September to November last year, the earnings estimates, they actually bottomed out and have been recovering. And this has been led first, I mean, initially in the second half of last year, it came with IT. But gradually, it has also translated into some of the domestic cyclical sectors. We have seen earnings upgrades in the private sector banks. We have seen earnings upgrades selectively, very selectively in the industrials. And I think this is likely to continue. So if one looks at this massive rally in the domestic cyclicals, it's been partly led by earnings upside, no doubt, but possibly more so by re-rating on the hope of a kind of a pro-growth government coming in place. So to that extent, yes, I mean, if we do get a disappointment from the electoral outcome, there could be a downturn or a derating in the domestic cyclicals. But, one must also say that, yes, I mean, there have been upside to earnings estimates as well.
Let's just assume for a minute that we do get a big election surprise, right, in terms of numbers. So, would you say that these are essentially the places where you will see most meaningful upside? So banks, infrastructure, industrials, road construction companies, power utilities. Manishi, broadly, I mean, you get the idea, right?
Absolutely. Yeah. I mean, I clearly agree with you. I mean, see, these are the classic policy-driven sectors, where the government policy can actually make a difference to the earnings environment. So yes, I mean, the expectations would possibly be the highest in these sectors. I would also include the oil and gas or energy space in the list of sectors that you talked about, because I'm sure the market would then factor in a certain hope about deregulation or a reduction in subsidies, and eventually what's happening to diesel that happened to petrol a couple of years ago. So oil and gas, possibly even telecommunications would also join that group, even though in case of telecom there are other issues like the large competitors entering that space and potentially driving down ARPUs and ARPMs because of competition. But I think surely the pecking order should be banks and financials, followed by industrials, infrastructure, and then oil and gas.
Right. Some say, well, the CPSE public sector, that index, right, which was that ETF, which was launched recently, that's a good place to sort of bet on. Would you agree with that, Manishi? It has a large oil and gas weight. It also exposes you to other things in the PSU space.
Yeah. Oh, of course it does. But as I said, that in the near term, you obviously would derive capital gains from exposure to PSUs as a whole. One could even expect some degree of PSU reforms, like stake sale in some of the companies, disinvestment, like we had seen during the BJP regime during 2002 to 2004. But at the same time, once that initial euphoria is over, obviously focus would come back to fundamentals. And then, there are certain sectors like the PSU metal companies, metals and mining, or the PSU banks, where the concerns on fundamentals are still severe. So I think, from a pure trading perspective, that PSU exposure might make sense. But over the longer term, particularly for institutional investors, we would still recommend caution on that universe.
Right. Two specific areas. One is road construction companies. The other is power utilities. What would your bets be there?
So in case of road construction, clearly the kind of companies which are not only winning projects, but also whose earlier projects are now becoming cash generative, and therefore the quality of whose balance sheet are going to improve going forward. So in that category, one has companies like IRB Infrastructure, which we cover. We have a buy recommendation there. There are many other companies which are also benefiting. I don't want to comment on them, but because we don't cover them formally. The second area that that you talked about was possibly infrastructure. And here, I would say that companies which are willing to repair their balance sheets by selling off assets, they should be the primary focus. And of course, the evergreen companies which have demonstrated their ability, their technical ability in pretty much every area of infrastructure, and which already have a relatively deleveraged balance sheet. The obvious implication being the giant in the sector, which is Larsen & Toubro.
Manishi, power utilities?
Ah, yes, I missed that. So in case of power utilities, you could divide them into two classes. First, you have the merchant power companies, which currently have a problem because their tariff applications and the requests for higher tariffs, that is still under litigation. And on the other hand, you have the regulated utilities like NTPC and Power Grid. Now, our preference in general is for the regulated utilities. But there, I would actually talk about, I will kind of make a distinction between those where the new capex or the new commissioning of new capacities are more visible, and those where there's a relative lack of visibility. So in that former category, you have companies like Power Grid Corporation, which, there are clearly new capacities coming through, and since they earn a certain regulated return on expanded capacity, one has a certain degree of visibility about earnings as well. We are still not very convinced about the merchant power companies. I'm sure there's a temptation to draw a conclusion from the political outcome that we're likely to get. But, I think it's still too risky a bet for institutional investors to take.
Got that. Any other names which come to the mind? I'm just sort of looking at the outcome this Friday. That is the backdrop or the trigger. And assuming that the verdict is going to be strong for the NDA. Some are saying, well, Gujarat-based companies, Gujarat PSUs. I don't know. Anything which comes into your mind?
I would not really venture into those areas. Yes, they may benefit from a pure trading perspective, and we have actually seen some of them move up quite significantly on the back of this political hope. But no, I think we prefer to stick to fundamentals. We prefer to stick to companies which have better earnings visibility. We prefer to stick to companies which have better management quality and corporate disclosure. And, from that perspective, I would really stick to the list that we discussed just now. That is, private sector banks, that should be the first set of companies, followed by very select few PSU banks, which don't have so much of capital raising requirement. Third, should be select industrials, which have the characteristics that I talked about. Some of the oil and gas companies, particularly those which are redefining their business, going from refining and marketing more into exploration. The obvious implication being BPCL. And finally, some of the telecom companies which have already demonstrated that they're behind the tariff reduction and kind of predatory competition phase and more into a stable phase right now. I would also talk about some of the merchandise exporters. I know there's a temptation to go severely underweight IT services and other merchandise exporters, but I would think companies like the frontline IT service companies or the companies like Tata Motors, they would still continue to benefit from this momentum in developed market recovery that we are seeing. And finally, I would end with a word of caution. I would say that India can't really grow. The Indian markets can't really explode in isolation. We would need that money flow into Asian or emerging market equities like we had seen during the 2003 to 2007 phase for a sustained bull market in India. And even though there is some recent evidence of emerging market flows recovering, I would still wait for more concrete signs to that effect to come through.
One last question, Manishi. So we are close to 7,000 now. In case there were to be a disappointment this Friday, what would you say? Would the last high which held for 5 years, 6,350, be that mark which must hold? for the underlying mood to still remain hopeful and bullish. Because if we fall below that, not only people who just look at charts, etc., but generally, a level which held for so long and has been broken out after so long, if we breach that on the downside once again, don't you think it'll sort of get doubts back into the system, whether what we saw was just a flash in the pan, how long before we take that out again and things like that, or it's no problem?
Well, for the kind of correction that you're talking about, I mean, 6350 is about a 10% correction.
Yeah.
For that, I would think, one needs to get a severe disappointment. So we're talking about a really, what should I say, a very weak hodgepodge kind of formation, which is not within the realms of expectation right now. If we do get such a disastrous outcome, then yes, one can't rule out a 10% or even a larger correction. But let's wait and see. I mean, over the next few days, that picture would become clear. I think it's kind of pointless to speculate about that right now.
Right. No, I wasn't saying, whether the outcome will be disastrous, but I was just saying that, is that an important technical and psychological level, 6350? That's my question. Not that we'll go to that, but that must hold in case there are corrections, drawdowns, etc.
Right. I think, I'm not really a technical analyst, so it is not really within the realms of my expertise, but I would think that, yes, I mean, certain support levels should be holding so that the confidence is maintained. Because otherwise one gets into the usual problems of, investor confidence suffering, and therefore, the concomitant problems of margin calls, etc. But, yes, I think some support levels, not just in the broader market, but also in certain stocks and sectors, are possibly important for the basic level of confidence to be maintained.
Manishi, thanks very much for that. Great chatting with you. Appreciate you staying on.